Well, the banks in general are making double-digit earnings growth at the moment. So that's mostly driven by higher margins as opposed to credit growth at the moment. And that's driving, and coupled with pretty tight cost management in general, driving very strong operating profit growth. At the same time, bad assets are not really an issue, so that's driving the low double-digit earnings growth at the moment. Valuations are still very attractive. At the same time, also we see catalysts, for example, for Emirates NBD, the increase in foreign ownership limit, which is taking longer than expected, but still a massive catalyst, as well as the merger of ADCB Hilal and UNB in Abu Dhabi.
Interesting to see lending in the private sector was up about 6.5%. So clearly the fundamentals that underpin some of the recent resilience that we've seen in the Dubai banks are still intact. But you mentioned Emirates NDB. Are there other banks that investors should be looking at right now?
There's a couple of interesting ideas. Emirates NBD is definitely one of our topics, as well as ADCB together with UNB. Is definitely a potential new, a new leading bank in Abu Dhabi. We think there's going to be massive synergies of combining the two, not just cost reduction, but also financial synergies. I think the cost of funding can be reduced substantially, so the overall return on equity will actually be improving about 3 percentage points. Valuation of ADCB is still extremely cheap, vis-a-vis the likes of First Abu Dhabi Bank, which was inflated because of MECI flows. So there's definitely some selective opportunities. Elsewhere, Dubai Islamic Bank is the bank that actually grows. It's taking over the role of Emirates NBD in terms of lending to the GREs, and that is throwing off very high double-digit earnings growth at the moment.
What concerns you the most about property stocks? What's going on?
The property stocks is mostly driven by the softness overall market. We think that the market is at least 12 months away from a market equilibrium. But also it's the cash flow picture. Investors are really worried about the cash flow picture. So if you look at the NIMAR, firstly, you don't have full recourse on the cash flows of the subsidiaries. Second of all, you have a lot of capex outlays. So the cash flow picture doesn't actually look so strong. So obviously the valuation is very cheap, but the cash flow picture isn't great, and you see actually leverage increasing at the parent level. So this is one of the concerns that investors have. So we think it's a value trap, basically.
Let's also talk about some of the other markets around the region, and we know that the KSA has been getting a lot of attention recently. Stocks in Saudi Arabia actually seeing some volatility, but in your research you're also pointing to some recent pretty big foreign selling in Saudi stocks. Do you want to talk me through some of the factors that you think those investors are looking at? Why are we seeing money coming out of the Saudi markets?
Yeah, interestingly, so the institutional buyers of Saudi stocks have been mostly macro funds, so just buying the baskets, and there's only picking the big stocks rather than looking at the fundamental stories. So there's an opportunity in the long run, but at the moment this is what's driving the market. Into the next year that will be the same. But if you look at the foreign inflows so far, I mean the foreign institutional holdings are about 1.6% of the market. That's only a tenth of what we expect into the new year. We expect 60 billion of inflows. So it's still a heavily underplayed theme, we think. And we think actually there's a lot of upside in Saudi into the new year.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.